Good afternoon, everybody. Welcome to O Economica, all about economics and finance. And I'm very happy to be with you all today. And if you're new around here, please watch the video. It's going to be very, very interesting, and we will see a lot of things that you will not find anywhere else on the internet. So watch the video, subscribe to the channel. If you can subscribe, that means a lot to me, because I put a lot of work in what I do. Just leave a like, and if you can support the channel, I will be very, very grateful. It's all free. You can subscribe for free, watch the video for free. It's everything free. So my last content, I've tried to show some hard data and trying to make sure to explain in the best of my abilities that what is the volatility in bond market, such as any other financial asset, is not determined by what is the 24/7 news cycle or what are the headlines on the newspapers. Those are completely useless things. We don't need newspapers. Or for what concerns financial markets or the stock market, what do we need are actual data. So the price of financial assets, what is the volatility, what market operators are doing, pension funds, what the government is doing if it's issuing new debt, if the Bank of England is doing, if any central bank is doing QT, quantitative tightening, if they are doing any open market operation, if they are changing interest rate, so forth and so on. So today's going to be very interesting, and as I said in my other content, I try to show you a few data to explain why the past Friday, the 14th of November, for example, or on the 11th of November, the gilts market, the UK sovereign debt market, became so volatile, and that was not due by by what was coming up on the newspapers, or was the rumors coming from the exchequer, they're gonna hike taxes or that and the other, because there are no numbers, so the market cannot price something that it's pie in the sky, like income tax hike. Without any data, I cannot price it, I cannot model it, so it's totally bonkers what you see in what the average British person that lives in the UK is totally bonkers what they are fed from the mass media industry. If it were for me, I would shut down all the mass media industry in the UK, because they are useless. They are very bad. It's a very bad industry. It's just tabloids. They don't produce any added value. They don't produce culture. They don't do anything. They don't do any good into the world. So I would, with bad people, I would get rid of them. That's it. So what actually happened is that for the functioning of the bond market in any advanced economy which has a huge financial system, the Bank of England, like any central bank, they have to implement short-term liquidity operations, which are called repo or ILTR, which are indexed long-term repo. And in simple terms, what they do, as I said, is that any bank and any pension fund or those financial operators which are eligible to tap the Bank of England, they take they fill out a form where they basically specify, okay, I'm pledging as a collateral this debt security, which is a 10-year UK gilts, which is worth this amount, and I need to borrow this amount. So in simple terms, what it happens in a repo operation, so here we have the table, okay, and we see here, for example, we can compare and contrast with what happened into the market here, okay. So we know that by Thursday this week, there will be £92 billion that will have to be moved from banks and investment funds towards the Bank of England. And that transaction, that movement, basically goes back into the reserve account of banks, okay? Because in any financial system, we have, in any economy, we have the central bank, okay? Let's call it CB, and we have banks. Okay, so in the case of for the Eurozone, we have the Euro system. For the pound sterling, they call it SMF, which is the Sterling Monetary Framework. And here we have Barclays, NatWest, Lloyds, and we have HSBC or Standard Chartered, how to forget, or any other pension funds, XYZ, and also hedge funds. Okay, also investment firms, which by their risk profile, if it's an hedge fund, it's an investment fund who actually deals in speculation in the stock market by definition, and they have a riskier business than traditional banks. Okay, the traditional banking system. So here we have the hedge fund, okay, hedge fund, okay. So we have pension fund, hedge funds, banks. All of these entities, they have strict rules on what they can invest into when it's for financial products. So pension funds, tendentially, they tend to buy gilts or sovereign debt, okay, from HMRC, not HMRC, HM Treasury, okay, from the Exchequer, okay. So the government issue debt, then the pension funds, they go into the open market and they meet the offer of the government of some debt with by demanding a certain amount, and that in the intermediary is the DMO, the Debt Management Office. So that's the mechanism that it's the same for any other country in the world. If we think of the United States, we have the Treasury, and they issue sovereign debt, which is U.S. Treasuries, and the issuance of debt is managed by the Treasury. I believe, I suppose that they have a department for the debt allocation. They do an auction of debt, so they issue, I don't know, a 10-year Treasury with a 4% yield and a 4.25% coupon, which is paid semi-annually, and the duration, it's on paper it's 10 years, but then when we discount the coupon, the present value of the future cash flow, we see that the modified duration is a bit less than 10 years, etc., etc. But basically, so what happens is that pension funds, which have to guarantee a long-term return in a longer time horizon, they tend to they are allowed to have sovereign debt, but they theoretically, but also by regulation, they cannot bet on credit derivatives or other riskier products. And then hedge funds, they can do pretty much whatever they want as long as they meet their reserve requirements or the leverage ratio and other regulatory things which I'm not an expert of. But hedge funds, their business is to speculate into the market. Banks, they are banks. They have customer deposit. They provide credit to the economy, to businesses. That's how it works. So what happens is that the Bank of England, for example, it expanded its balance sheet to 970-80 billion. Here we have the peak was here on the 12th of January 2022, and the maximum size of the balance sheet was 978 billion 766 million. Since then, the monetary policy stance has changed everywhere, like the ECB has. ECB is already far away in cutting rates, but all central banks, they have hiked interest rates in these 2 or 3 years, and then they are they began unwinding the quantitative easing with the QT, and so the size of the balance sheet of the Bank of England, it went from 978 billion to 630 billion now, which is a big number. So it means that the Bank of England, as we saw the other day, it has actively sold 348 billion of gilts, of debt securities. And these debt securities have gone from the central bank, back to the financial system. So then what happens is that when we have this, let's see if I can, okay. So when from the central bank we have some sort of treasury that goes to the banks, then cash goes to the central bank in a certain sense. So what happens is that 348 billion of pound have been drawn out from the financial sector. So less liquidity, it's going into the financial system. I've been a bit muffling, but the basic functioning of QT is for the central bank to issue back the sovereign debt, which is then allocated, is bought into the open market by the pension funds or the hedge funds or the banks. And of course, what happens is that cash goes back to the central bank, okay, in a certain sense. The net effect is that liquidity goes down into the financial system, into the financial market, okay? So, by doing this operation, what happens on the other side is that the yield and the rate of return of a bond goes up. So we have yield going up because even the central bank becomes a net seller of sovereign debt. And with this, you have the government, which at time with the DMO, for example, it has to issue debt. So it throws into the market debt, bonds, okay, and it wants cash. So the equilibria in this whole financial and in the economy and in the banking industry, because then banks, they have current account with the central banks, which basically are the amount to the bank reserves. So when the central bank does QT, basically we debit the bank reserves, we debit the account. So the Bank of England takes money out from the Barclays or Lloyds or HSBC account that they have with the central bank. That's the mechanical working of these things. And the level of reserves in the banking sector, it's very healthy. It's nothing of concern. So we see here there are the official data provided by the Bank of England. Anybody can go on the Bank of England website. They can find the data, at least the data on the surface, because we don't know, we don't work at the Bank of England, so we don't know all the ins and outs of things. But it's very good to know that bank reserves, they are 600 and okay, that was in 2024. So we see that now in Q1 2025, bank reserves, they are 616 billion, and that was the first quarter of 2025. So we are missing another 6 months of market activity and then all the QT and stuff like that. But we see that bank reserves from in 1 year, from Q1 2024 to Q1 2025, they have decreased by minus 1.1%, and that is the net effect also of QT. Okay, and then they have basically the categories of what is Tier 1, common equity Tier 1, Tier 2, etc. So it's the different types of financial securities that they have. So Tier 1, they must be the most liquid assets, which can be cash or bonds, government bonds, and other, and pretty much like deposits or the bank reserves and government bonds. So those are pretty much the things. Tier 2 level of financial securities, those are a bit less liquid assets. I should go and read exactly the details of all these things, but the concept is that. So Tier 1, those are the most liquid assets. And the ratio, these are what count, because these are important for when there is when any central bank or any financial authority that they have to carry some stress tests from period to period. They want to know that the Tier 1 and the common equity Tier 1, they are well above 12, 13, 14%. So the health of the banking sector from a regulatory standpoint, they are pretty healthy. They are not UK banks, they are not short of reserves. And also this concept has been provided from the Bank of England in their press briefings to the journalists, so to the press. But they basically I don't know, they don't understand. I have no idea. So the health of the banking sector, they are pretty healthy. They have plenty of reserves. Certainly they could have more, and there is the scope probably for a higher level of bank reserves. I'm the last person on earth, but it's just by simple arithmetic that maybe going into the future it will be the same staff at the Bank of England, etc., economists and people who do this work, that by doing some simple arithmetic, they will start to see that maybe banks, they need a higher level of reserves in order for the whole financial sector to function better, and also for the term premia or the risk premia of the yield curve to be contained. So to contain the cost of borrowing for government, probably the level of reserve, it could be much higher. That doesn't mean that there has to be QE, but paradoxically, that means also the government will have to issue more bonds to make sure that more bonds are on the balance sheets or of banks, so that they have more reserves and also there is more money supply. Or on the other side, I think that something which will be very, very healthy for the UK economy is that British people, the saving ratio should be much higher. So there should be some incentives into saving, for people to saving, and those are saving in cash, in bank deposit, rather than buying stocks or having cash ISAs which are investing stocks. I think that from the point of view of simple bank reserves, like liquidity of cash, which can then be used for investment, that would be a much healthier thing to do, because then savers, they could choose to have, I don't know, a 3-4% saving account, or probably try to invest in bonds, in government bonds, so that the level of reserve in the banks it can increase, in order that liquidity in the banking sector it's higher. Having more reserves, it guarantees that the capacity of money supply for investment in the private sector, it's much smoother. The transmission mechanism of credit creation for the private sector is much smoother. So if basically the government, it's a no-no for issuing debt, then the saving ratio, it has to increase for the banks to be able to provide more investment opportunities vis-a-vis their requirements of having reserves and Tier 1 and common equity, Tier 1 bank reserve, adequate bank reserves for the whole financial industry to work. So the data tell us that there are no risks in UK banks. They are pretty much well capitalized, and I think there is a case for bank reserves to be higher in order for the economy to work better and for the risk of the yield curve to be lower. So there is plenty of data. Here there is another aspect where they describe what are the risk-weighted assets. So risk-weighted assets is where the whole banks, they have all the books with all their financial assets, all the investment that they hold on their balance sheets, and then they have to apply some financial calculus formulas, and then they assign some weights based on the risk and the solvency risk, the credit risk to all the investment that they have, and they come up with some risk profile, and here we have the total amount, which is 2.9 trillion. Then you see here, so total risk-weighted assets, they have grown, so it means that banks, they are investing into riskier assets, which can be stocks or whatever is their business, and we see how market risk profile changes from one year to another, or what are the operational risk and credit valuation adjustment. So of course the central bank knows everything. They must have all this data, but they present it to the public, and they so that people who are in the business of the financial sector, at least, but even ordinary people, they have an idea of actually what are the real stuff of the City of London, or what does the Bank of England, or what is the how healthy is our UK banks. And nevertheless, a higher saving ratio would be beneficial for sure. So going back to why the yield curve becomes volatile, we are already at the point that the Bank of England has drained from the financial sector 348 billion in liquidity, and so that means that also bank reserves. Reserves is actually the pounds, the cash that banks have with the Bank of England. That amount is slightly going lower, because every time the Bank of England does, when the Bank of England or the Federal Reserve of the ECB, when they do QT, they debit the bank reserves account. So they debit Barclays, they debit HSBC, they debit Lloyds. I don't know what they have, 400 billion current account at the Bank of England. So when they do quantitative tightening, banks are debited according to the internal process of how it works QT. But that's pretty much the mechanism of this thing. And we will find this useful to understand another thing. So that although banks, they have bank reserves with in an account with the central bank. Okay, here we have banks. So here we have banks. Here we have pension funds. Here pension funds. Here we have hedge funds. Okay. And other investment funds, Okay, sometimes there are many more things, because there can be custodial banks, then there are clearing houses, CH, like in London there is a which is a third counterparty for other things, but there is LCH in London, which is a huge clearing house. They clear pretty much every day 1 trillion euros in derivatives. Okay, so the eurozone is very beneficial, at least to clearing houses in London. They generate fees for hundreds, tens of billions of euros or pounds, how you wanna define. But in all these arrows of things that revolve around the central bank, there are custodial banks. I say there are pension funds, investment funds. There may be, like in the UK, there are building societies. Okay, so whenever all these entities, which are banks and so forth and so on, they respond to the requirements for the central banks and to the regulatory authority, and they are able to access credit directly from the central banks, so they can access two types of liquidity, which are STR, which is short-term repo liquidity, and ILTR. So what happens is that if you go and read what the Bank of England said, is that they were going from because they started QT, so they have drained minus 348 billion from the whole financial industry. They're gone into the central bank back again. So let's put it this way. So, and they do QT. Okay, so the balance sheet on the Bank of England, the size of the balance sheet decreases. It's like going on a diet, leaning into the thing. At the same time, they know, because they know their business. Also, the Federal Reserve does it, and the Euro area, or the Reserve Bank of Australia, or the Central Bank of Canada, or whatever you like it, the Bundesbank, whatever you want. So what they have to do in order for we know that the bank rate is 4%. Okay, interest rate is 4%. So what the Bank of England does, it's different from the Federal Reserve. And I made a mistake in the other content. I will put the link into the description. Because the Federal Reserve, let me just move around. What the Fed does, they have repo rates. So what happens is that if the Fed funds, or the bank rate, it's 4%, they set the repo and the reverse repo interest rate. They set the benchmark, and also they have a tri-party repo, which involves a custodial entity. There is a third intermediary. So the federal dollar money market and the federal banking system, is structured differently from the sterling monetary framework, and as well as the euro area is structured. Its structure, it's not identical neither to this or the other. So if the cost of dollar in money market is 4%, the Fed says, okay, the repo is 4.25, okay, and they set also for the reverse repo 4.25. You can basically, anybody can go and on the Federal Reserve website and find exactly what are these STR, which are short-term liquidity facilities that the central bank provides. Why they do that? Because it's actually very simple, and at the same time is very important. And it has also to do, for example, with what happened in 2022 with the pension fund crisis in the UK. So what is different between the dollar system, the dollar money market, is that the Fed, it sets the repo rate, and it sets the reverse repo rate, and it sets the tri-party repo rate. While instead the Bank of England, if the bank rate is 4%, also the STR is 4%, is exactly as the bank rate, the STR. For what it concerns the ILTR, so the long-term, which is a 6-month liquidity facility that the central bank provides, in this case the Bank of England, through the sterling monetary framework, what they utilize an HC, which is called an haircut. Okay, I will show you now. Okay, what is an haircut? An haircut is when you go to the barber and you want to cut your hair. It's a technical term, and they have here. So what that means is basically is that if I have a level, we see here they have created 3 levels of debt security or financial security that any financial institution can deposit to the Bank of England in order to receive a 7 days or a 6 months liquidity credit. Okay, so there's level A, level B, and level C. There should be somewhere level C. But anyway, level C, we can call it RMBS or ABS and stuff like that. So asset-backed securities. So they take pretty much anything. Even Fannie Mae. This is very fun. They have all sorts of things, which I don't know how. Anyway, they must have a very hard stomach to digest all of this stuff. But so the haircut are these things. So what that means is that if I need, let's say Lloyd's Bank. Okay, Lloyd's Bank wants £100 million. What they do, they fill up a form and they say, okay, I'm going to give you a 10-year gilt sovereign debt, central bank debt of UK issued sterling, euro or dollar or Canadian dollar. So the level A collateral, it's actually UK sovereign debt or even euro area sovereign debt or treasuries, you see sovereign, so they accept sovereign debt from any country in these lists. United States, Canada, Spain, Portugal, New Zealand, anything, even Chinese debt, whatever. So Lloyd's says, okay, I give you a 10-year gilt, okay, and the value of the bond, it's 100, the face value. So what the Bank of England does is that, okay, we need to use this 0.5 haircut. It depends if it's a coupon bond or it's a zero coupon bond, okay, and it says, okay, I can give you 100 times 1 minus the haircut, which is 0.5, which means it's 100 times 0.95, which means it's 95 million. Okay, so that's basically the simple arithmetic, and that works for the ILTR. So the long-term repo, the 6-month liquidity facility that the central bank provides, it's established with these tables. So if basically somebody goes, let's say NatWest, okay, it has I don't know, 400 million in credit derivatives, which are residential mortgage-backed securities, then the Bank of England will apply a 12 points haircut. So for 400 million, they will receive much less, okay, and then after 6 months, for example, after 6 months, Lloyd's will have to pay back those 95 million to the central bank, and then they will receive back their 10-year gilt, okay, their the level A debt security, which can be UK bonds or Canadian bonds, whatever you like. But the main difference you see here, okay, it depends. Here we have even if it's a floating rate, of course, or they have to specify if a fixed rate. So if, for example, and then there is the duration, if less than 1 year, 1.3 years. So in this case, I made a mistake. So if I have to be very precise, okay, if it's a 10-year gilt, okay, and the duration is 10 years or between 5 and 10 years, then it will be 3.5. So the haircut will be 1 minus 3.5. So it will be 1 minus 3.5. Oh dear. Yeah, actually I made a mistake. It's not 1 minus, but it's 100. 100 minus what is the haircut or the discount rate for the thing. So for 100 million and the bank gives pledges a 10-year UK bond, then the haircut is let's assume it's 3.5 points. So is the market value what is 100 million, okay, minus or times 100 minus 3.5, which is the haircut, divided 100, okay, so that will be 100 million times, that will be 96.5, of course. So all in all, for 100 million of UK bonds, the bank will receive 96.5 million, okay, because the central bank, it applies all these factors to each and every kind of financial security that the hedge fund, the bank, or the pension fund, they pledge as a collateral or as a guarantee against their short-term liquidity or their 6 months requirements for liquidity. And you can see here what I was saying is that when we go into the space of, I don't know, asset-backed securities like credit derivatives, then the haircut points that the banks, the central banks, applies on the credit derivatives, they are much larger compared to a level A sovereign bond. Okay, so it means that for how much is risky the collateral that the bank provides to the central bank in order to receive some liquidity, then the value that they receive, it's actually less, because the central bank applies these factors, which are called haircut, to the market value of the debt security that the banks provides as collateral. And by the way, these are important for any central bank to do, because in the case, it's very, very simple. Whenever the Bank of England or the Federal Reserve or the ECB, they drain out money, and we are talking about hundreds of billions, whenever they drain out money from the financial system, then central bank is a monster. So on the other end, they provide some liquidity, and they do it with the STR or the ILTR. That's what they do. So they do QT, but actually they don't do QT in very simple terms. Otherwise, the whole banking sector, the whole financial industry will be in too much stress. There will be so bank reserves, or what are the liquidity that other pension funds or investment funds they hold, it will be drained so much that the whole system will grind to a halt. You risk to have a much larger crisis. But what is important is that the central bank sets the bank rate. Okay, the bank rate. In this case, we are at 4%. Okay, so here we have the banks. I think you all remember the hedge funds, pension funds. Okay, we all remember the LIBOR problem. So when there was the 07-09 crisis, all money markets, they start to freeze, because what happens is that Barclays or HSBC or NatWest or Lloyds, they have their own money market funds, which are basically cash. They are deposit account where you invest into the prevalent bank rate. And those are money market funds. So when there is a freeze into the system, they don't lend to each other, and that causes for the LIBOR, okay, to spike. Okay, so the LIBOR was set, if I remember properly, because I was a young boy, any bank would submit a quote or a reference parameter for which was the reference rate that they were willing to provide credit to other banks. And so by some sort of magic formula, they went to an average or something like that, and every day the LIBOR was established by banks. And then you can say that all sorts of arbitrage would have been made. I don't know, because I was too young, and I don't know exactly how it was. But pretty much all the banks, they submitted their reference rate, and then the average rate was extrapolated, and then that was the LIBOR rate for that business day. Now what happens is that it's very simple. If the central bank doesn't, okay, we have STR there. So if the central bank, basically, STR is for 7 days, okay? So the short-term repo is for 7 days. So, and it's done at 4%. So that means that the cost of borrowing for 7-day liquidity, it's 4%. It's exactly the cost of money that is set by the central bank. Now, the short-term and also the ILTR facilities, they are very, very important, because they provide liquidity, so they keep stable the cost of borrowing and predictable the cost of borrowing for banks. While vice versa, if the Bank of England doesn't do STR, right, what happens is that banks, they will have to provide liquidity to each other. And so whenever this bank here says, okay, this is risky, what happens is, if they have to provide 7-day, even overnight liquidity, it happens exactly what happened with in 07-09. Then they see, oh, the bank rate is 4%, say, I'll give you liquidity at 8%, okay? So the whole cost of borrowing, it diverges a lot from what sets the central bank, and then the whole system goes haywire, because you can see that if I'm borrowing overnight at 8% yield, then all the credit flows between banks are freezing, money markets are freezing, and then credit is not flowing into the banking industry, into the financial markets, and so you have a collapse. Okay, you have big problems. Let's not talk about collapse, but you have big problems between banks that they cannot settle transaction within each other. So it's basically everything. It's frozen like the like the ice age. I don't know, whatever. So that's why these facilities, which are the STR and the ILTR, they are necessary, especially when the bank is doing QT, because with QT money is going from banks. The current account that banks have with the BOE, it's debited, and so cash goes from banks back from the system, from the whole financial system, from the banks to the central bank. So they are short on liquidity. So on the other end, what happens is that the bank can go and say, okay, I give you a 10-year bond, right? And then I need for 7 days, I don't know, 5 billion, 4 billion, 100 million. And then they will pay the bank rate, 4%, which is not the same as the Federal Reserve, because what happens is that because there are intermediaries, the Fed, there are banks here, okay? So what happens is that an hedge fund, which has a account with JP Morgan, let's say, so JP Morgan actually acts as an intermediary for the STR. So it's not, it can happen that it's not directly the Federal Reserve that gives money to the hedge fund, but the hedge fund gives treasuries, gives the bond to JP Morgan. JP Morgan posts the bond to the Federal Reserve. They access, I don't know, $100 million, 100 million. Then JPM gives this 100 million to the hedge fund for their operation. And so that's why the Federal Reserve sets this repo and reverse repo and tri-party repo. So when there are intermediaries or custodial banks, it sets 3 different rates, which are not the same as the federal fund rate. Because then when there is an intermediary, they can earn a spread. Okay, so it means that theoretically, JP Morgan borrows at 4 and then provides an STR at 4.25. So they earn plus 0.25. I don't know, overnight or for 7 days. So that's how pretty much the mechanism. For what I have been reading on how the Bank of England decides to do its sterling monetary framework, they don't have intermediaries, but banks, they fill out a form where they specify which level or which kind of financial securities they are pledging to the bank, how much they want, what is the market value, and so the Bank of England theoretically say, okay, I can give you this amount conditional to this haircut factor, etc., etc., etc. And so the transaction happens. They have specific methods to do that, digital methods to do that, but pretty much there is the functioning. And so the STR and the ILTR, they are very important because the central bank has taken 348 billion pound. They are taking it back. But with the total amount of STR and LTR, it's 140 billion. 140 billion pound. So what that means is that the Bank of England has stabilized its own balance sheet. Okay? So they brought the balance sheet to 630 billion. I think I have the bank tables, so we can see the bank tables together. Okay. So they brought the balance sheet to 634 billion, down from 978 billion. So net, not net, but gross amount. Okay, if I can do something. Okay, sorry about that. So here we have the bank table, and oh dear, sorry about that. So you see here reserve balance 643 billion on the 12th of November. So that was past week. So if we compare it with here, this line here, okay, is the weekly amount by the end of October. Reserves were 630 billion. Okay, so it means that actually in 12 days the Bank of England has eased a little bit. They have bought first 21 billion, because here we were at 651. Okay, 651. Then on 12th of November they were 643, so they sold 7.9 billion or 8 billion, let's call it as billion, 7.9. But vis-a-vis this data on the 29th of October, the balance sheet was 630 billion. Then 1 or 2 weeks after, they added 12 billion, okay, 12 billion and change, or 13 billion and change, or 21 billion. So what that means is that in the past 2 weeks of November, the Bank of England has actually bought some debt. They have taken on their balance sheet some bonds, okay? And now these are the reserve balances, 643 billion. But at the top of quantitative easing, they were at 978 billion. Okay, so they have shrunk a lot. But here we have the data. It's very, very interesting. Okay, short-term repo 85, ILTR 55. So what I said also in the other content is that they have shrunk the balance sheet, but because the whole financial industry needs money to work, also the economy, then banks and all the eligible financial operators, they have tapped into the Bank of England for 85.6 billion, okay, which are 92 billion this week, and 55 billion. So if we make a sum, it's 10, 13, so it's 141 billion, okay? So what that means is that the Bank of England has withdrawn 348 billion up to now, but they have provided, to keep the cost of borrowing stable for banks, 141 billion, whether it's STR, short-term repo, and these are for 7 days, okay, and ILTR, which are for 6 months, okay, for the operations, for the day-to-day banking and investment funds, for the financial industry, they need money. That's how it works. So the net effect of QT, it's 207 billion up to now, okay. Actually, we have to make minus 7, is 200 billion, because the short-term repo, it's 92 billion. It's not 85. It's 92 billion, which is it comes up in a couple of days' time, on the 20th of this month. And okay, let me on which page we were here. Okay, sorry about that. Yeah, you see, these are STR. It's 92 billion. Okay, so net effect is 200 billion. So QT, right? So the net effect of draining money of bank reserves from the whole banking industry, it's around 200 billion. So what that means is that, in very simple arithmetic, is that when the Bank of England basically does QT, okay, and they are in 978, if we subtract the 200 billion, which is the net QT, then the balance sheet, it's easy understood, it's 778 billion pound. But nowadays, the balance sheet, it's total reserves on balance, it's 643. So there is actually the total reserves, they are less than what would theoretically be if QT would have been calibrated at 200 billion. Okay, and that does mean that it's banks would have not asked for STR or ILTR. That does mean that banks don't require short-term liquidity. But what that does is that basically controls a little bit better the behavior of the yield curve and the volatility of the cost of borrowing, because the Bank of England, instead, the central bank, instead of throwing into the market 348 billion, they know that they cannot go any further than 220 billion. So the active sales that they can do, at least up to now, in 3 years, okay, we can do a proportion, like the T variable, which is 36 months. No, so they started in February 2022. When they started, we can see here very quickly. So the balance sheet peaked here in January, okay, and they started in January 2022, so 23, 24, 25, Yeah, it's pretty much just T is 35 and is 36, like for 46 months. T is 46 months up to now. Okay, so basically in a 3-4 year time, the neutral level of QT should be 200 billion. Okay, these are, for me, they are empirical observation from which I can understand, given a certain level of bank reserves in a certain span period of time, months, how much, what is the amount of reserve that can be drained from the system without causing any distress, so that banks they need to ask for a lot of short-term liquidity, because then basically we go from a stable levels of reserve to a less stable levels of reserve. Why? Because the STR, it has a term which is 7 days. So I need to, okay. So the STR, it has a term of 7 days. So it's different if I have a stable 778 billion reserves on the central bank, and these are basically money of available to Lloyds, to bank reserves, okay, bank reserves. And so I don't have, STR would not be 92 billion, because these 92 billion, they expire every 7 days. Okay, so having a neutral level of bank reserves, it guarantees that the whole economy, the whole financial industry, it doesn't have to scramble all at once every 7 days for short-term liquidity. And when it's 100 million, 500 million, 1 billion, 10 billion, it's okay. But when it's 92 billion, then it's sizable. Okay, so because if we do 92 divided 643, it's okay. That means that at the moment the banks are bidding 14.3% of their reserves. Okay, because where it is, we know that bank reserves are 643 billion. They ask for an additional 92 billion in a 7-day short-term repo, and this 92 billion, it's 14.3% of their reserves, which are 643. So they need 643 plus 92 to work, and at least every 7 days, which is 735. Okay, 735. Okay, we are pretty much here, which is 735 is pretty similar to 778. Okay, so the neutral level of reserves that theoretically the Bank of England should hold if they don't want too much risk in the short-term repo market, it should be between 735, 770 billion pounds sterling, because we are in the, that's the SMF, the sterling monetary framework. Okay, so the level of reserves, at least for what are the conditions now, it should be between 735, 770 billion pounds. And paradoxically, as I was saying before, because bank reserves, they are created also by issuing government debt, paradoxically this would require the government G to issue more bonds, so that banks can buy bonds and then give it to the Bank of England and then receive cash in the case of quantitative easing. But the government has to issue more bonds because bonds, they are collateral. What that means that NatWest buys 5 billion pounds of gilts, right? Or bonds. They have a certain duration, 5 years, 10 years, 30 years. And then NatWest takes these gilts, it goes to the central bank and says, okay, I want STR. And then they receive 5 billion, and then they will have to pay 4% bank rate on the STR. Bank rate. So, what that means is that the liquidity concept, liquidity, is not only it's cash, and near cash, which is bonds, government bonds, GB, government bonds, right, or gilts. Those are the most liquid form of financial securities. That means if you have gilts, you give it to the bank, they're gonna give you straight out pounds. Okay, so the government, paradoxically, it has to issue sovereign debt in order to maintain or to guarantee that there is enough liquidity into the financial markets, because, as I said, government bonds, they are used as collateral, level A, sovereign debt, etc. So it means that they are worth money. It means that government bonds can be used as a guarantee for a credit line that the central bank gives to the commercial bank, to the high street bank. Okay, and also government bonds, they are instruments, they are saving instruments. Okay, I think there is in the UK they have the oh dear, NSNI, which is the National Saving Trust and Investment, which basically they provide saving products, which are government bonds. Can be zero coupon. They do also some sorts of lotteries or some lucky lotteries or whatever. But the government bonds, they are saving products for retail investors, okay, for ordinary savers, for British people, and also for foreign investors. Okay, so the higher is the rate of return, which is the yield, and the coupon, the lower is the cost of the bond, but then it's the better is the rate of return discounted for inflation. Okay, so if we go to the Fisher equation, we know that we have the real rate of return, it's nominal rate plus inflation, etc. So, all in all, government bonds, the government borrows. I mean, Rachel wants to borrow, or whoever is the George Osborne, or was Ken Clark, Norman Lamont, or who was the Chancellor of the Exchequer, they issue debt, but bonds, they are also saving products. And as we go here, okay, we just we already saw that by doing simple arithmetic, that the optimal level of liquidity of bank reserves should be around between 730, 750 billion pounds, 770 billion pounds. But to improve the level of bank reserves, then the whole economy can increase the rate of savings. That means that what that means is that where it is, yeah, it means that ordinary people, they go to NSNI and then they take, I don't know, £1,000, 1K, and they invest in bonds. Okay, green bonds, not green bonds because they are risky. Zero coupon bonds or gilts, right? That's it. They give you gilts. Government bonds, and you will have, I don't know, 5% plus, and you will have to see 4%, 4.5%, right? And there is the coupon. Then on the basis of the coupon, you do all the calculation. You see what is the present value for your cash flow. They give you a price, etc., etc., etc. But then you park 1K, 10K, 100K, okay, just 50K, like, just put it out of the casino. I want my £50,000, right? You take your £50,000, right? And you go to NSNI and you say, okay, I want £50,000 of government bonds, and you park it out at I don't know, 4.5%, and it stays there for 10 years, and then it grows. Let's see if I can do. If we do 50 times 1 plus 0.04 to the power of 10, let's compound it in years, it's 77. That means that if on a compounded rate, eventually that £50 will be worth £77.60. So you're gonna gain a lot, okay, almost more than 50%. So investing in government bonds, it's also a very good investment, because it's those are very safe savings. Okay, so whenever you live in the UK and how can I say, you hear the doom and gloom and say, oh, the cost of borrowing, etc., etc., etc. To improve the overall economy, so the saving ratio should go up. So it means that ordinary people, they should be incentivized to save into government bonds. That means that you should, I don't know if it's already the case, but the basic thing that you can do is that you can provide a tax advantage, or a waiving some fees, or a lower taxation for those savers who invest in government bonds. And on the other side, what you can do is something very, very important, like what Rachel can do. Rachel, what Rachel can do? Rachel, what can do, it says, okay, I will give you 5%, I'm making an example, 5% tax rate once a year on any lump sum invest with NSNI, so in bonds, in gilts, right? So if you are a British person, if you live in London, you live in Birmingham, wherever you live, in Leeds, in Glasgow, in Edinburgh, what Rachel can do? And she got a problem. Have you got a problem? No, you haven't got any problem. So they say, okay, I give you a, when you do business, you need to provide incentives for people to invest with you, to be comfortable with you, to trust you. Okay, so say, okay, if you are a saver, I give you a 5% tax rate. It may be that this stuff already exists, because of sure they will have some fiscal advantages for those who invest in with NSNI and stuff like that. But they should, for example, they could eliminate any sort of limits, upper limit for people who invest in sovereign bonds. Okay, they keep their their life savings, their pension in government bonds. But at the same time, what Rachel can do is say, okay, I take capital gain tax. And I create an arbitrage. I say, okay, I put capital gains tax equal to income tax. Okay, what is 20, 25%? I don't know what is the latest rate of income tax. Somewhere around 25%, excluding national insurance. With that, you create the incentive and the tax. You use the tax system to create a tax arbitrage. So any person, any XYZ person will say, okay, if I have to invest into the UK, what the Treasury does, what Rachel does for me, it gives me a 5% tax on any lump sum that I invest in government bonds, and I keep the money there until the debt, for all the duration of the debt, what is 10-year gilts, 30 years, the money stays there, nobody moves it, okay? They cannot touch it, okay? And you can do that in form of savings with NSNI, and with pension funds. Okay, it already works like that. Yeah, this is a very well established industry. But what Rachel can do, they can provide a tax incentive. They say, okay, if you do business with NSNI, with the pension funds, I give you 5% one-time tax on the lump sum that you invest. Okay, so every year the tax rate is 5% of your investment, or by the end of the time that you are retiring and you are withdrawing your investment, you will pay 5%. While instead, if you do a cash ISA, you want to invest into stocks, you will have to pay 25% capital gains tax, which is equal to income tax. Okay, so you create a constrictive, you have to create a nasty tax arbitrage and say, okay, so that you funnel liquidity into reserves, into bank reserves, not literally into bank reserves, but that pot of saving, you push the saving ratio higher, so that pot of saving becomes liquidity available for investment. What that means is that when people, they are saving, then the bank can give out credit for businesses to operate, and also the government see that the cost of borrowing goes down, okay, because there is more demand for government bonds. But you have to create the demand by, for example, I just taught it now on the hoof, not really now in this very short termism, but the very simple all-day breakfast example. Okay, let's say we are having an Ulster breakfast. Okay, my hunch is that if I do this and I hike capital gains tax and I keep a very low lump sum tax on any saving that is made in government bonds, then I create the conditions for savings to go towards government bonds, to financing government bonds. Whenever there is more demand, the yield goes down, there is less volatility. And then also it's also good because savers, they are not scared if the market goes down 80, 90, if it goes down 50%, because there is an ocean of difference between having your cash ISA, which is exposed to Vanguard ETF, MSCI ETFs, or Nasdaq ETF, S&P 500, Nvidia, Oracle, I don't know, crypto, bitcoins, real estate, while instead having your pot of savings, 50, 100 grand, million, 2 million, whatever is the amount, I don't mind, into government bonds. That is much, much safer. It's a stable return that you have. That's it. The money is there and it's accruing interest. And it's better, it's way, way, way much better for the whole economy, because there are more savings that banks and the government can utilize. They can utilize the multiplier effect of the reserves and the money reserves and the deposit that they have. They can apply some multiplier effect of the fractional reserves or whatever you want to call it, and they provide credit into the economy. And so that would be much, much better for the overall financial side of things, and also for the economy. It's a way to finance the private economy, enterprises. It's a method to finance the government, and then the savings, they are good also because credit can go also into the economy. So after all this mumbo jumbo, if you want to take a pause, we can go back to the to our very funny friend, which is the STR and the ILTR. So we saw basically that volatility in the gilts market, if we see here, for example, the past week, which was, so the STR, it's open every Thursday. So every Thursday of every week, any bank in the UK can fill out a form, send the electronic form to the Bank of England and say, okay, I have that kind of financial security, I need this money, and then they bid, and then they receive the answer from the Bank of England. They say, okay, we can allocate this amount for these conditions. Can be the, the STR, it's at 4%, so there is no much going beating around the bush. But while instead, the ILTR, the long-term repo, it's they have three kinds of spreads, and also they have the haircut, which is, they have three different types of basis points of spread that they utilize for the ILTR, and it's 0.03, 0.2, and 0.4. That is, for 0.03, it's for level A, level A, level A, level B, and level C. So for each and every kind of debt security that they use as collateral, not only they have the haircut, but also they have some basic spread in basis points that they utilize to basically define how much credit that they can give to the bank or to any financial institution that requires this the amount of money that they ask for. So as I said in the beginning, is that the volatility in the past week, which was here, you see here, that's the 10-year bond. It started to be volatile around the 11th, and then the 13th, you have a huge rise up to also the day after, the 14th. And you see here that the maturity date of the STR, the short-term repo, was the 13th of November, okay, which was past Thursday, right? And what happens is that these 85 billion and 687 million pounds, they were moved from the financial industry, from banks and all the rest of it, towards the STR liquidity facility that provides the Bank of England. So you have a huge movement of billions, tens of billions of pounds. So, and what happens at the same time, here you see that the same day, banks, they asked for 92 billion. So the STR increased by 6.3 billion. It means that banks seem shorter and shorter of liquidity. And because of the, as I said, the STR, okay, here we have the BOE, it's 4%, okay, so I have any other bank, Standard Chartered, okay, they say, okay, I need, I don't know, 4 billion, right, and they post as collateral, I don't know, 4 billion of 30-year gilts, right? So they actually, as if they were doing a sale, okay, a short-term sale, although it's technically not a sale, but they use it as a collateral. Then the bank gives 4 billion to Standard Chartered. But the next week, in 7 days, then Standard Chartered goes back to the Bank of England and say, okay, I need 5 billion now. So it seems that banks, by the the evolution of the total amount allocated that you can all see here. The total amount allocated grows and grows and grows and grows. We can see it's very, okay, let's go back to this. And because between the 13th and the 14th of November, you have this huge movement, so that 85 billion and 600 million of cash have to move from banks to the Bank of England. And then what happens is that 92 billion of debt securities have been posted as collateral to the Bank of England for that amount of liquidity. You can easily understand that if I'm using, I don't know, 92 billion of UK gilts, the yield goes haywire. Yeah, that's what happens into the market. This has to be very, very, it's important to fix in your mind, okay? So the bank, to do this STR, this short-term repo, they have to guarantee with financial securities. So they give gilts, they give bonds to the Bank of England, and then they receive pounds, right? They receive 4 billion, 5 billion. In this instance, past week, there were 85.6 billion of STR going from the bank, which had to be paid back after 7 days, okay, to the Bank of England. So the banks, let's say, like generally, let's say the financial industry, they paid back the liquidity they asked to function, 85 billion and 600 million. But then what happened is that they filled out the form and they said, okay, we give you 92 billion of gilts, which is sovereign debt. Okay, and then the cost of borrowing goes up because you are moving so large amounts of gilts that the cost of borrowing goes up. Why? Also for a couple of reasons. One is that there is perceived risk in the market. So it's risk, short-term risk, because it's 7-day liquidity, 7 days. But also it's because there is scarcity of collateral. Okay, so the government needs to issue gilts, needs to issue bonds for the market to function, unless, for example, some government bonds which are held by foreign investors, they decide to sell it to UK banks, which is something pretty much normal. But they don't do it because they earn interest. So why they should do it? And also it's bad for financial stability. But anyway, yields, what happens? The chaos the past week was not for income tax and the headline on Sky News and stuff like that, or what is this? That guy, it's I don't remember his name, but there is the guy that takes the data from the OBR and wants to explain. And the OBR, it's total bullshit. I'm sorry. I would never work at the OBR. They are pretty crap at working with data and modeling data. They are pretty crap. And they can do an Excel thing and say, okay, the projected rate of borrowing will be this, that, and the other, which is pretty much it's very good. I'm not saying that I'm better than them, but I've been reading their documents and I do not reckon the feasibility of their projections. Okay, if I have to take some data, I go to the Bank of England. I know that they know what they are doing, they know their numbers, and there is a universe to learn from the Bank of England, but the OBR, I mean, I can do without. So, because past Thursday, 85.5 billion went back to the Bank of England, and 92 billion of gilts have been used as collateral to receive 92 billion in cash, then of course you have that the cost of borrowing on the 14th of November does this little joke. It goes from 4.4 to 458. It jumps up of 180 basis points, 100 basis points. Okay, so no BSP, but it's BPS. Okay, 100 basis points. So that's the reason. That's the real reason. Okay, I'm not taking any pie from the sky, or not flying any kite, or any speculative things which are not in the realm of the real things, the real deal. Okay, so here 85 billion, and on top of that, there were these other auctions here. Okay, so as it happened on the same 13th, the past Thursday, for the ILTR, the 6-month liquidity facility, also they had to pay back 555 million. It's this amount here, that amount. Okay, so if we take 85 and 600 million plus 500 million, it's 86 billion. So these are huge amount of money. But on the same time, past week, on the 4th of November, they asked for an additional 3.6 billion. Here, you can see the transaction here. Okay, so the operation date, 4th of November, 6 months is the term. It has to be paid back by the 7th of May. Then the whole system, they needed 3.695 million. And for the concept of scarcity of collateral, okay, we can find the evidence, the empirical evidence here. Scarcity of collateral is a factor of risk premia. Risk premia for the term structure of the yield curve, right? Which means, in simple terms, cost of borrowing goes up because there is the scarcity of collateral. What happens is that banks, they scramble into the market to find collateral, and though there is a lot of activity in selling sovereign debt. Okay, and anyway, we see here, you see the amount of level C collateral is 1 billion. Okay, so the bid that was submitted to the Bank of England, it was composed in this way: 2.6 billion and 2 billion and 600 million. They were level A collateral, which is sovereign debt. But level C, okay, level C, it's this stuff: RMBS, ABS, and all other sorts of things. Okay, so it means that there is scarcity of bonds into the market. And why? Not because the UK has a wonderful debt to GDP ratio, but because banks and the financial industry, it's leveraged. Leverage. There is leverage. It means that they already used the past week. They already used 92 billion of financial securities for the short-term repo. Okay, and then they had to use another 3.6. So very, very easy. Let's make an easy 92 plus 3.645. It's 95. Total was 95 billion 645 million pounds of liquidity, of money that the whole financial industry required 1 week to another. Okay, now this 3.6 billion, they have a 6-month term, but that was the overall amount. I mean, no, that's 4th of November, so they are not aligned. So I'm sorry. So, but anyway, the sense is this one. Okay, 4th of November, it's even before. Okay, even worse. It was between the 30th of October and 6th of November, the bid of the short-term repo was 97 billion. So plus 3 billion, we are north of 100 billion, 100 yards, right? Okay, so what that means is that the system needs a lot of money to function, and because they use tens of billions of pounds of sovereign debt and other financial securities, which can be euro area sovereign debt, it can be US treasuries debt, because the UK banks, they hold something like 400-500 billion of treasuries. So they can use US treasuries as collateral for short-term repo. That means that the yield curve goes up because there is a scarcity of collateral, and there is perceived risk because the amount of short-term money that the system needs, it's growing and growing and growing. And that goes back to what we said at the beginning. So that quantitative tightening, probably the optimal level of reserves should be a little bit more than 700 billion. And so then what the Bank of England will do, I don't know. But if we take the 30-year gilt, which is the most battered by the what I call repocalypse. So the high volatility determined, you see here, 13, 14, 13, boom, 14, boom. The market, basically the yield jumps higher, 120 basis points, 0.12%. You see it closed, Thursday close was 523, Friday open was 535 here. It's huge. You have a mispricing, a misalignment of the bond price, which is huge. Okay, then you will have to take the bond price and do some fancy mathematics, do the modified duration. I can do it, but not now. And see for 0.12% of the cost of borrowing going up, how much the value of the bond, of the gilt UK bonds, how much the price goes down, the monetary value goes down. Because every time the cost of borrowing goes up, the bond market value goes down, the monetary value goes down, and that causes this. It's a factor also for a persistent volatility in the yield curve, and a growing amount in the STR. Because when the value, it's very, very simple. It's very simple to understand. When the collateral, okay, scarcity of collateral. So when the value of gilts in pound goes down because the yield, the cost of borrowing, goes up, then this becomes financial stress for banks, for their short-term funding. And that basically means, in very simple terms, that my gilts are not worth 100, they are worth 90, okay? So I need more collateral, more bonds. Because the face value of the sovereign debt that you hold as a liquid asset is decreasing because the cost of borrowing is going up. So instead of being worth 100, it's worth 90. So after 7 days, then the STR, you still need 100, then you will have to give this one gilt, which is worth 90, plus, I don't know, gilt, which is worth 10, to have the same amount. So it means that you need two. You need two financial securities. You need two debt securities. And this goes back to here, so to scarcity of collateral. So the cost of borrowing and the volatility in the cost of borrowing, it's a determinant factor. It's important. Whenever the cost of borrowing goes up, then you have all sorts of mechanisms that kick in because the value of the bond goes down. And if I'm scrambling for the STR, for the short-term repo, for the 7-day money, right? Then if I have some bonds that I can use as collateral, and then I need to add some more financial securities to get to the amount that I need for my hedge fund to work. And basically, when you are in a situation of huge distress, like such as in 2022 with the LDI crisis, there it's a disaster because the market sells off, the value of the bond goes down and down and down, and the more you have a cascading effect because the value of the bond goes down, the banks need liquidity, and so they sell more bonds. They sell more, and then the yield goes up. This part, yield, the cost of borrowing, this goes higher and higher and higher. And it's a domino effect. It's basically a very nasty situation that I would never repeat ever again. That's why probably it would be a good idea to have a much higher level of reserves, and that would be for the Bank of England to decide, not for me, for sure. Now I can happily show you all the actual data that I worked through with the Bank of England data, which are available to anyone on planet Earth. And here we can see very easily Bank of England balance sheet, okay, in trillions, okay? So you have a very large balance sheet expansion, and then by January 2022 they start QT, and we saw that they drawn down to 640 billion or something. So these are the reserve, it's the reserve balance, which basically are the bank reserves at the Bank of England. I hope that they are the bank reserve at the Bank of England. And yeah, we see here the asset purchase facility, how it's basically, it has been decreased since 2022. And these are the quarterly balance sheet changes. These are back at 2008. So there is QT, but it's not real QT because you can see here that the one week repo operations, which are the STR, they have jumped to 85, 92, 97 billion. And the index, the ILTR, they are at 55 billion. So the net liquidity that the financial industry it has been asking since 2024, it has totaled around 140 billion, which is a lot. That means that banks are well capitalized. There are 630 billion of reserves, but for their day-to-day operation, because there is an asset bubble, because the cost of borrowing it's higher, because perhaps there is somehow there starts to be scarcity of collateral and things like that, then the banks, they have tapped more and more and more into this short-term liquidity facility, okay? And yeah, you can see here the liquidity ratio compared to the balance sheet size, we are at 17.5%. I made it, it was before 14.3%. Total liquidity provision, we are north of 120 billion. Here we have a it's interesting. It's really interesting to see, okay, how this blue line, dot by dot, since January 2024, you have a growing amount of the short-term repo going on. And then if we sum up all these amounts that they have been bid for every week, we have gone up to 92 billion, 97 billion. These are the 6-month repo. And you have a big ILTR in 2020 or 2016 because of Brexit and some other kind of volatility events. And now, since 2024, as a method of managing liquidity and bank reserves, financial institutions, they are able to access the ILTR to the Bank of England. And there is, as I said before, there is an haircut. So there are some factors according to the risk that they weight for the financial security that is used as collateral for a 6-month liquidity facility. Then there is the haircut. There are basis spread that are utilized for clearing the auction, okay? Because this index long-term repo, it works as an auction. So what the central bank does, so the bank fill out the form and says, I need 1 billion, and I will post level C collateral, and they will take, I don't know, 20 basis points, plus 0.4 basis points of spread. And on the basis of how liquid is the collateral, how liquid is the auction, then the central bank decides, I can give you 1 billion, I can give you 800 million for level C collateral, and then I'll give you 200 million for level B collateral. And then at the end of the auction, what is it? The bank, it's able to pay 40 basis spread. The central bank assigns the lowest spread. So at the end result, they say, okay, I've given 1 billion, and then we apply the haircut of 20 points, and the spread is 0.35. Okay, so by the end of 6 months, they will have to pay back 1 billion plus 0.35 of spread, and etc. A little bit more than 1 billion, and that's the business of the ILTR in broad bins. Okay, really broad bins situation. And we see here that since August 2025, also in 2025, it's the use of the ILTR as a method of managing liquidity has been growing and growing and growing, and the total is 55 billion up to now. But what I found out is that, and here we have a theoretical framework that I tried to put together by gathering all the data from the Bank of England and all the things that we saw together that anybody can find on the Bank of England website, how they do the STR, how they do the ILTR. They have an auction process. There are some haircut factors. There are in the ILTR auction, there are some spreads that are applied, and then putting all together all these things, I have put together a theoretical framework of the sterling a theoretical model of the sterling monetary framework in order to understand and to prove the concept that there is in the market yield curve volatility, and the UK bond market becomes more volatile and the cost of borrowing can increase or even decrease, but most of the time we see that the cost of borrowing jumps up by 100 to 100 basis points because market participants, they adjust before and after to the STR and to the ILTR. So when there is scrambling for short-term liquidity, then the bond market adjusts. The term structure means the cost of borrowing, it adjusts before and after the Bank of England carries its auctions for the long-term, the 6-month liquidity facility and the 7-day liquidity facility. So it's definitely not because of the headline or the news cycle, but everything is defined by these equations that we will see in a second. They are pretty straightforward, and these are you can find this equation in all the literature of studying the yield curve, the trend structure, or financial quantitative calculus and stuff like that. So the modeling, and then when you have an equation, you can input the numbers that you have, the data that you have, just what is the yield curve, what is the beta or the lambda parameter, or what is the standard deviation, and then basically you can get to a real data that you can observe in the market. So as I said, the Bank of England, like any other central bank, and also in the bond market, when there is distress into pricing debt securities, we have a haircut function. What is the haircut? You go to the to the barber shop or the Turkish barber or something like that. The haircut function, as we said up to now, is the ability. I'll just rewrite what are the formulas. So we have a z parameter, z of alpha, which is the confidence, the critical value. So if we want a 95%, 99%, 99.9, etc., 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 then we have a sigma, which is the oh my god, I'm writing with I'm not using a pen but the mouse. So we have a sigma parameter, which is the volatility of the asset. Then we have the square root of t, which is the time. It can be 7 days or 6 months. 6 months. We have to bear in mind that 6 months, if we can calculate 6 months in two different with two different methods, which is nothing complicated. We can define 6 months as more or less 180 days, unless we shrink the 6 months. We define it as the 5 business day in a week. So it's basically it's just 22 per month times 6, and we are at 612, so it's 132. Sorry. So these small tiny details, I'm not so sure what we can do the equation with 180 days or 132 days. Personally, I would prefer to use the 132 days because that defines clearly the duration of the business days. But I mean, these are tiny things. So and then we have plus L, which is the liquidity premia, then 1 minus an exponential, of course, because exponential, the Euler number is everywhere, plus, sorry about that, let me take a bit of space, plus rho, which is okay, and plus times sigma. So with this haircut function, we are able to calculate the discount factor, which is provided by using the discount factor that is provided by the Bank of England or the Federal Reserve, the table of discount factor that they use for level A, level B, and level C, the collateral. We find out that in a linear, it's a linear function, that the asset volatility. So what the chart says, that volatility here increases as the haircut goes up. It's a positive sloping straight line, so it's a linear correlation between the two things. And as much as if I have a discount factor of 0.5, then the asset volatility perhaps that would be 0. Asset volatility would be here at the bottom, let's say 5%. Okay, but if I have a discount factor, or okay, here it's in 0.5. Okay, if I have a discount factor of 0.35, then the volatility in the asset is 0.4. That means it's 40%, something like that. That means that when there is the higher we are in this point of the chart, that means that the value of collateral goes down, because the larger is the haircut, the discount factor to the market value of the collateral. So it makes more difficult for any financial institution to not to access the short-term liquidity. But it's very, very simple. So I said it also before. The larger is the haircut, the smaller is the larger is the reduction in the market value of the debt security. That means that that creates a volatility effect, and then there is a scarcity of collateral in the market, and then that is it's a cause for volatility into the bond market. That's one factor. Another factor which is very interesting in this instance, and here we see here level A, level B, and level C, what are the implied percentages of implied haircut or discount factor percentages for the face value of the debt security, market value of the debt security. What is interesting, it's actually this function here, which is basically is the derivative interaction between the liquidity premia and the reserve adequacy ratio. And we have this formula, which is that one, okay? So the liquidity premia, it's an alpha factor, and then we have E, and we have a gamma factor, RAR, which is the reserve adequacy ratio, plus delta, and then a volatility factor. So what that means, it's very simple. Because we have a negative exponential, we see that we don't have a linear function, but it's a downward sloping relation between, and we can find the derivative point at any point of the curve. And we see here that when here we have 1, which is the RAR. So for RAR, which is smaller than 1, we have higher liquidity premia. So for RAR, which is larger than 1, then we have smaller liquidity premia. And the liquidity premia, it's basically also reflects the cost of borrowing. So that means that always going back to the availability of collateral for financial institution in order to access to bid for as much liquidity that they need. So if the reserve adequacy ratio, which goes back to the bank reserves, it's okay, and then we calculate the parameter and it's larger than 1, then the implied liquidity premium when there are auctions for the liquidity facility, then the liquidity premium it's smaller. So if I have, I don't know, I just want to make an example which is not entirely correct. Let's say an STR, it's 4%, okay. If I have an optimal, let's say an optimal larger than 1 reserve adequacy ratio, I will have to plus a liquidity premium LP of 0.05. Okay, so theoretically the effective cost of the STR will be a little bit more than 4%, but we know that the STR is a fixed rate, which is the equivalent of the Bank of England bank rate. But this liquidity premium, going back to our concept, is that the liquidity premium is reflected into the yield curve, or here into the cost of borrowing. Okay, so when there are auctions for bidding the repo facility, then the liquidity premium is reflected according to what are the conditions into the banking sector for the levels of reserves. These then are reflected as a liquidity premium into the yield curve. And here, for example, we have a huge expansion of the liquidity premium the day after the auction, because investors they sold securities into the market for what are their reasons of doing that. But it's not definitely it's not because of fiscal policy. It's because we have all these equations that define what actually happens into the market. And here we have these two models, which is the Nelson-Siegel and the Vasicek models, which help us to price the term structure of the market, of the bond market. And these are very interesting, and they are both necessary, because the Vasicek model is for short-term rates. So is for short-term rates, and basically it's linked to the Bank of England bank rate. So we have DR dot T and your K. It's actually very simple. We have theta minus ROT DOT plus the Wiener process, which is sigma DWT. I'm sorry, this is the derivative of the Wiener process. It's very simple. It's absolutely incredibly simple. We have this K parameter, which is the speed of adjustment. We can empirically calculate the speed of adjustment, this K parameter, speed of adjustment. So how fast adjustment occurs of d of RT. Okay, so the speed of adjustment of the short-term interest rate in proportion to time. Okay, so the K parameter, we define a K parameter, and then we have theta, which is the average interest rate that we are considering. It can be the 1 month, the 30-day interest rate, the 60-day interest rates, the 90 days interest rate, the 1-year gilts, minus RT. So this formula is very, very simple. So we have the average interest rate minus the, so we have 10 years worth of data. So we take the average of the 10 years data for the 1-year gilt, and we subtract by the interest rate that we have in that moment in the market. And we see that when this parameter can be smaller than 0, it can be equal to 0, and can be larger than 0. So what that means is that the speed of adjustment is pretty much equal to so because they are very important to understand, and because the level of reserve is important to understand, to calibrate, then we have this thing is called kink point. So it's the level of reserve demand and supply into the whole monetary framework, which basically keeps in equilibrium the whole system. And we could actually think of that the reserve demand it's equal to 100 times E. We have always an exponential function minus a factor nu, which is basically the reserve supply minus the reserve demand. So, of course, we have an exponential function, so it's not a linear definition. And in this case, we consider when the reserve supply is larger than the reserve supply at kink point. So when during Qt we have a shrinking, here it's 100. And we have another case when, in this case, we have that the reserve supply is less or equal the reserve supply at kink point. And this n parameter, which is a Greek letter for nu, it's basically the elasticity, right? So it's an elasticity between supply and demand of what? Of gilts, of bonds, right? So when there is more demand, there is less supply, then you have higher value for the bonds that we require as reserves. So, and how this basically all goes into the monetary framework, or the what is called the monetary policy transmission mechanism. So we have that R equals the bank rate, let's say 4% this time, plus CS, which is the credit spread, plus the liquidity premia, plus the term premia of the yield curve, plus gamma times RA, which is the risk aversion in the market. So there are many, many components that help us understand what is the monetary policy transmission mechanism. So we have the bank rate, and then we have the credit spread, we have the liquidity premia, so how more expensive become borrowing, gathering liquidity in situation of market calm or distress, and we have the term premia on the term structure, plus some gamma parameter times the risk aversion. So if the situation is risky in the market because, I don't know, one day you know that one bank will not be able to pay the overnight borrowing or the 7 days borrowing, then you have a lot of risk aversion into the market. And for this reason, there is the systemic risk index, which basically defines the risk, not perception, it's the risk, the systemic risk in the market, which is derived from all these other parameters, the liquidity premia and the market risk. And so the systemic risk, we can build it by assigning weights to the STR and the ILTR. So we try to build the systemic risk into the market, systemic risk index, which takes as input the STR and the LTR, or the requirements of bank to tap the Bank of England for short-term liquidity. So we have W1, which is the weight of the STR. Okay, in this case we have amounts, what is 80 billion, 90 billion, 100 billion, whatever is the amount, plus the second weight that we assign to the ILTR. Okay, so it's an index where we assign a weight or a percentage to the ILTR and the ISTR plus W3 to volatility, VIX. There is never enough space to do these things. Plus another weight parameter to the ERCAT weighted asset. There should be better HCWA. So because banks, they have the risk weighted asset, we can use the same similar functioning, mathematical functioning. We basically produce a ERCAT weighted assets. So we weight the different discount factors that have to be utilized for separate financial securities, so that we get to a weighted average of the ERCAT component, and so we can build a systemic risk profile into the market, which assigns, it's a weighted risk index, okay, which assigns a certain weighted risk to the STR, to the ILTR, to the volatility component, and to the discount factor component. And by doing this, then I have proceeded into using the time series, the data, in order to extrapolate real time information about what does the market. So we put together a systemic risk index, which is a weighted index for all these parameters, which are actually reflected in what happens in the bond market. Banks need short-term liquidity. So we start to build a framework that can give us a clearer picture of how repo and liquidity stress into the market create bond market volatility. Here we have basically implemented other two types of framework, and these are mostly used to understand how the constraint in the collateral channel, so the scarcity of collateral, basically creates additional liquidity premium and additional risk and yield curve volatility into the bond market. And we see here this chart is very, very simple. These are all that's the theoretical framework with which I worked, and I then used the real data. So here we see that the systemic risk amplification, it's non-linear, and on the basis of how constrained is the collateral availability into the market, then we have higher levels of liquidity premia that can expand the cost of the short-term repo rate. These are determined by that function that we already know very well. So that's theoretically the cost of repo, so is the bank rate plus beta parameter times the liquidity premia. So this beta parameter sets the sensitivity then to the liquidity premia, 1 minus the collateral quality. So the quality of the collateral that is exposed can, because we have level A, B, and C on the quality of financial security that is provided. And so we can mathematically define how much liquidity premia expands and what is the additional cost that then goes into the, in this case, the ILTR for banks, and how difficult then becomes to gather collateral in order to have liquidity in the short term. And here we have some very basic things. It's where it explains the software helped me to understand that basically in broad beans terms we have the derivative of the ERCAT in proportion of the derivative of vol, which equals 0.15. And that's interesting because basically it tells us that for every 1 unit increase in the ERCAT, so in the discount factor of the collateral, or the market value of the collateral, that implies that volatility goes up by 15%, or sigma is 0.15. So there is a partial derivative effect between the quality of the collateral and the systemic risk amplification and shock intensity into the cost of borrowing. and the cost of borrowing, or the cost of the spread of the ILTR. And because the short-term volatility is at a fixed rate, what that means is that this volatility shock, they reflect into the yield curve. So the cost of borrowing into the market goes up, and we have yields that are spiking because of these constraints. It can be collateral constraints, it can be liquidity premia, which is linked to the quality of collateral that is pledged for liquidity, and these shocks amplify also in a period that is from 10 to 20, 25 days after the first period of stress. So that's why I say that the market adjusts to the STR and to the ILTR volatility or constraints before, but mostly also after the liquidity auction take place. And in fact, we see here that we have an adjustment the day after Thursday, in the past week, the day after, we have a drastic adjustment in the cost of borrowing. It means that we have volatility in the bond market. And that's because all these transmission mechanisms, which refer to the availability of collateral, the quality of collateral, the liquidity premium into the market, the systemic risk into the market, and we can assume that if we take this framework, I'm sorry, it's not very clear, but because the STR, we assign a weight 1 to the STR, okay? So if the STR is 100 million, then we have some weighted index of systemic risk in the market. But if the STR is 90 billion, then of course for the same weight that we assign, then the systemic risk index into the market is much higher. And that then basically propagates all sorts of haircut or discount factor, weighted average factor into the systemic risk into the market. So the expansion of the repo market and also the index long-term repo market, they determine the overall systemic risk. But this is not news of now, it's always been like that. But also for the sterling monetary framework, the people at the Bank of England can estimate the king point of the balance sheet, so the supply and demand of bank reserves, the equilibria point of QT, how to calibrate QT, and then on the basis of QT and other market conditions, by observing the short-term requirements of liquidity into the market, the leverage ratio, and the systemic risk into the market, they can determine also how far this contributes to the cost of borrowing volatility. So there is a component of the fiscal policy, but there is a much broader component of markets, of the bond market, and what banks do for their own business. And so here, with the same method, I try to synthetically replicate how the ILTR auction works. So how the ILTR auction works, and by synthetically replicating the mechanism, we can find exactly what happened. We can define in empirical terms what happened with the LDI crisis, and there is a framework or reference for any sort of market distress, liquidity distress. So what the Bank of England requires is that to use the ILTR, the minimum bid should be, if I'm not wrong, 7 billion or 8 billion. Before it was less. I think they will expand the minimum bid requirements to 7 or 8 billion, and the maximum bid is 35 billion that they can allocate for each and every auction. So we are not talking about nuts. For the Bank of England says, okay, you can come for the ILTR if you need minimum 7 or 8 billion pounds. Okay, don't come for the ILTR for less in aggregate. Let's put it like that. And what do we find is that, of course, if stress levels they are high, then the Bank of England instead can use the full scale of the ILTR and expand to 35 billion. And basically, we find two things which everybody remembers, is that here we have the systemic risk into the market, the idiosyncratic risk into the market. What happens is that, for example, when we have liquidity crisis, liquidity distress, liquidity crunch, or LDI crisis, we see that the demand for the ILTR, for liquidity, is much higher of the supply. So the Bank of England has a maximum plafond of 35 billion. In a period of distress, the market needs more than 35 billion, so the demand is not exceeds supply, and that creates problems because there is scarcity of money into the market, and then that causes all sorts of volatility because then it forces funds to systematic selling of any other financial security, which includes sovereign debt. And what that means that then the spread at which the auction are cleared, then it changes. So what that means, you can see here, okay, when there are normal conditions, the ILTR spreads, they are normal. But when we go in a situation here, these bars here, when there is a liquidity crunch or there was the LDI crisis, you see that also for level B collateral, which is the middle bar, then the clearing spread, it widens a lot. It goes from 4 basis points to 12, 11 basis points. So it means that the additional cost of borrowing that it's placed on the LTR goes up. Okay, the cost, the liquidity premium, the cost of having this liquidity for 6 months through the LTR, it expands because of liquidity distress into the market. Okay, and the LDI crisis it expanded way more the level B collateral additional cost compared to a liquidity crisis, liquidity crunch. Okay, so it was really an idiosyncratic moment for market, but that explains how the spread, the clearing spread or the additional cost, it amplifies during period of stress, which is can be expected but can be avoided by no means of any other measure. And so by synthetically replicating the functioning, the mechanism of the ILTR, because the ILTR works with haircut, with clearing spread during the auction, so there are other factors that determine the pricing and the cost of borrowing, and those then are reflected into the market when the shock amplification, it propagates 10, 15, 20, 25 days after, or even also the day after. Okay, so probably you need a chill pill for the day after, something like that, I don't know. So under normal scenario, we see that the collateral scarcity index is 0.56 bips, which is normal, and it places a smaller additional cost on borrowing. So it means, in very simple terms, if I'm bidding for 100 million, this famous chuck 100 million, 100 million times 0.56, which is this one, in a normal scenario, it means that additional cost is £5,600 in this case. Okay, but when there is and we have an equilibria which is within the ILTR parameters, where there is 29 billion plus of supply and 12 billion of demand. Okay, so there is supply of collateral, and which is enough, which is ample supply of liquidity, and the demand is less. Sorry, collateral, supply of liquidity, and the demand is less. So the Bank of England can provide ample liquidity. But during a increased demand scenario, so more liquidity is needed, then collateral scarcity index, because it's required more collateral, and the value of bonds tends to decrease because we have gilt yield volatility, so we have 0.40, so the cost of the volatility in the bond market goes up, so yield vol goes up by 0.4. What happens is that the bonds collateral as instruments, they are scarce, okay? And so the risk index amplifies the cost of borrowing for the ILTR by 1.57. And even if the total supply, the overall supply from the central bank is 35 billion and the demand is 20 billion, then there is an additional cost of borrowing, which is not anymore 0.56, but it's 1.57. Okay, so it's a little bit, it becomes more onerous, more expensive for banks to gather short-term liquidity. In monetary terms, let's do it with the calculator. So 100 million here is going to take a long space and something like that. So 1.57 is not easy to do because to transform it in bips, 1.57 should be 0.000 Okay, it means that for every 100 million, I would be paying, not me, but the bank would be forced to pay an additional 15,700 in additional cost for gathering liquidity in short term. And the same basically goes for when we have the LDI crisis, and then we have that the volatility is way higher. We have a volatility shock of 0.787, and the additional credit spread risk premium because of scarcity of collateral, it's 11.76. So bips, which is a lot more. It's the equivalent of saying the additional cost, it's 0.1176%, 0.12%, 0.12%. As an additional cost to clear the spread, the auction spread for the ILTR. But that also becomes an additional cost for the yield curve. So it means that also the bond market volatility can increase by this amount, 0.12%. And if we would like to try to understand in monetary terms what that means, is that, for example, let's take in the calculator again, if I have a million or a billion in collateral, let's presume, for example, it's level B collateral, so it's not sovereign debt, it's some other financial asset, can be corporate debt or even credit derivatives or something like that. If we have to utilize this parameter here, which is the additional risk, then we multiply by 0.0, there's 1 0 less, 1176. It means that for every billion, there is an additional cost of £1,176,000. And for a bank, which is, or a wider financial industry, which is already in a situation of liquidity distress, and then they have to borrow very, very large amounts, which are in the billions of pounds, then when this collateral scarcity amplifies the cost of borrowing, then it adds up the liquidity distress, the liquidity premium, the market distress, and also the yield curve. Basically, cost of borrowing for the government goes up. Yeah, we can measure it here. That we have a collateral scarcity index. We can empirically measure how many basis points the scarcity of collateral and the gilts market volatility creates additional cost. And then there is another factor which is not negligible, that even if the Bank of England is able to supply 35 billion pounds, the market is in a banks funds, they are in this liquidity distress, they have margin calls, so the demand exceeds what is the supply of the central bank, and that causes additional problems. We are talking about a crisis, okay? But we can measure by synthetically replicating the functioning of the ILTR what are the additional costs and the liquidity premium expansion for banks when they need funding, short-term funding. And these are they are really, really interesting. And okay, what else? Here, I used a very simple method, which was a OLS regression with some dummy variables in order to understand synthetically what are the resulting impacts. And we see that for the STR dummy, so we replicate synthetically the volatility impact for the short-term repo and the index long-term repo, and we see that the short-term repo has a larger effect in terms of yield volatility. And the clearings, in this case, using a OLS regression, which is a linear regression, so we see that the clearing spread tend to compress for as long as the central bank can supply more liquidity than the market needs. But still, I find that the STR basically, even if it's a dummy variable, creates some yield, some borrowing cost volatility, even if basically it's a fixed rate at the Bank of England rate. And we can have some abnormal yield change by 0.43 basis points, which is not humongous, but still it's something to be considered, because what happens into the market, it's also a function of the liquidity that banks need. Okay, so here we have, again, the charts of the total amount outstanding, what are the liquidity needs for UK banks, the whole pension fund industry, hedge funds, investment funds, building societies. So we are here at 80 plus billion. And this does not mean that they only use, what can I say, UK gilts to do this business. The Bank of England accepts also US treasuries or other or Eurozone sovereign debt as a collateral. Okay, so these amounts I do not is 55 billion for the ILTR and 92 billion for the STR. I don't have the private data because those data are private, or what kind of debt security collateral has been used. Okay, it can be UK sovereign debt, can be US treasuries. I'm not in the business of knowing what is, but what we can see, what I've been saying for the past 2 or 3 hours, is that the use of the STR has surged by 2024. So it also during 2023 and also immediately after the lockdown, because banks, they are managing their liquidity, and probably there is liquidity stress, or perhaps the QT, the quantitative tightening, has gone too far, and so the level of bank reserves should be replenished a little bit, or the saving ratio should be improved so that there is more liquidity into the banks. There are all sorts of factors, and you can see mechanically that there can be yield volatility impacts on, according to where is the ILTR, is this red line going up, so there are more requirements for 6 months liquidity, and so that determines that the cost of borrowing here goes higher. Let's see, no, I cannot do that. And so I tried to figure out on a log scale how much yield curve volatility goes into, how much of the ILTR and the STR go into the yield curve volatility. These are synthetically replicated. What can I show you next? Okay, so these are very interesting, and I will tell you immediately, because by using a machine learning model, which is called random forest, you see that here the R squared is 0.85. What that means is that by using machine learning, we are able to anticipate and to understand the volatility, the standard deviation across the many, the yield curve linked to, here is the 10-year standard deviation, so the 10-year gilt. By using a machine learning model, we can understand the 10-year gilt volatility, and by injecting the STR and the ILTR parameters, we can understand how the gilt market volatility evolves with machine learning, because of the fact that banks need liquidity in the short term, and they go every week to the Bank of England and they say, okay, I need 80 billion, 90 billion, etc., etc., etc. And these are not isolated things. What do we have? As I said, the level A collateral, sovereign debt, can be UK sovereign debt, can be US treasuries, can be anything. But for those who do the work, if you use a random forest machine learning method, you have these kind of results. At least I have these kind of results. That the R squared, okay, it's 0.85, so it's highly significant. And also the root mean square error and mean average error, they are very, very small. So the error is very small, and the R square parameter, it's very large. And that's why the random forest method, it's very useful to understand and some sort of predicts, for example, the 10-year gilt standard deviation when it's linked to the STR or the ILTR. So what else here we have? We have an expanded model of the machine learning method. So here we have an expanded machine learning method, which basically helps us understand what is the market volatility. In this case, I think that it has been implemented only for the 10-year gilt, with the data of the 10-year gilt. And again, you see the machine learning method can easily predict 85% of the 10-year gilt volatility, and I believe it would be, perhaps it's this, pretty much it's a very high parameter for all other bonds. And the root mean square error is very small, the absolute error is also very small, so the predictive error, they are small. It means that the prediction of the machine learning model is pretty much very much accurate. And all these parameters, what they tell us? They tell us that the long-term base volatility, it explains, 35%. Can I erase something here? Probably. It explains 35% of the bond market, the 10-year gilt volatility, and that it has at 0.29, it has a 29% 8-week momentum. So the persistency of volatility is a key driver. The momentum in volatility is a key driver of the cost of borrowing for the gilts term structure. And also here we have the 26 weeks against the standardized average vol. So here that parameter 0.0437, it basically explains how the current volatility in the yield curve compares with historical volatility, with historical cost of borrowing, so it's the standardized average of the standardized cost of borrowing 26 weeks compared with the market volatility, and so the extreme volatility accounts for 4.3%. Also, we have a 4-week momentum standard deviation, which accounts for 0.2.5%. So it means that short-term volatility acceleration accounts for 2.5%. But what is interesting is the 8-week momentum. So it means that 29%. So if volatility goes up and the cost of borrowing goes up, the momentum, the 8-week momentum, it means that once the trend is in place, this parameter explains 29% of what happens into the market. It means that when there is an uptrend in cost of borrowing, then it tends to persist. It has a persistency element. And so, in other words, you say that the trend is your friend. So if the trend is up, it will continue to go up. It seems that by machine learning, that the gilts market, it has this characteristic, so that the momentum factor, it's all for all financial assets. It has a 29% weight on an 8-week period average. So it's important and it's useful to have more data that can help us understand what happens into the market. And so here we have different volatility regime analysis. So we see in 2020 or 2022, we can take periods back to 2007, 2008, 2009, or to, I don't know, or other periods, the recent market volatility. And so we see how, in this case here, it's the 10-year gilt, how volatility behaves into the market according to the different volatility regimes. So, and we see how, for how long of a period the market stays in that period. So low volatility regimes, they last 118 weeks, medium volatility 120 weeks. Okay, these are basically related to the period of time. And here, okay, we can observe something more interesting, which is the volatility term structure, the volatility in the term structure, which is the whole yield curve. And it tells us very insightful information, but that pretty much whether if we examine the short-term duration, the medium, or the long-term duration, then we have similar volatility structures, which means that as you can see, the average vol parameter, the average sigma parameter across durations is 0.11 something, or and the mean parameter is 0.10. So we are talking about something between 10, 11% vol, whether it's short-term rates, long-term rates, etc., etc. And the results that we have from the machine learning model, it tells us, okay, that the key drivers for example, in this case for the 10-year gilt vol, is the long-term volatility parameters, as I said, the 8-week momentum indicators. It tells us that once a trend is in place, it's a strong indicator of past changes. They are strong predictors of what is the future volatility of the borrowing cost, and also how far from the standardized parameter of the borrowing cost, how far the volatility deviates from these trends. And here we can see how since 2022, the 10-year gilt has been in a high volatility regime. So it means that with the concurring fact of QT, so the Bank of England shrinking the balance sheet, the rising bank rate, volatility in the bond market, then the whole cost of borrowing of the UK cost of borrowing is in a high volatility period, and it would be better to bring it below the 0.02 parameter into the lower volatility stance, so that it's less difficult for the fiscal policy to manage the cost of borrowing, for the Bank of England, all sorts of things. It's better for the economy, and here we have all sorts of nuances and particular parameters. Here in this chart here, we have the volatility term structure. We have a 13-week moving average of the volatility term structure. So we have a 13-week average of volatility for the whole of the yield curve. And we see how between 2022 and 2023, we have this huge spike in vol, 0.12, 0.14. So 12, 14, 15% vol up, higher volatility for the whole term structure. That means for the whole of the yield curve. Whether you are borrowing 5 year, 10 year, 30 year, it's higher. And the higher it's the 1 year, so there was a lot of volatility up to the 1 year duration cost of borrowing, which also is related to the fact that the Bank of England had to hike interest rate. But here we see that lately the volatility has been declining, and so hopefully it will go to a lower vol environment. Hopefully, it depends by many factors. And here we have the rolling volatility statistics with the 1 plus or minus standard deviation, and all this. We have the 26 moving average vol, which is this brownish line. So we are smack in the middle of this 1 plus or minus standard deviation, but we are the market, the gilts market, the yield curve is probably between 0.03 and 3 and 4% vol, weekly vol, okay, or 26 moving average weekly vol, which is not negligible for bonds, which are supposed to be not so volatile. Yeah, we see here average it's 3%, the median is 2.7%. So it's the distribution of volatility. It's the minimum, the average volatility has been 3%, okay, for the old data that we have up to now. And we see how major crisis period can be lockdown, COVID, or the bond market crisis, how volatility, instead of being 0.03% becomes 12-15%, because the market goes haywire for all the nice things that we pull together. That means that the liquidity premia, the discount factor, the scarcity of collateral, the availability of liquidity, so the supply of liquidity, the demand of liquidity, the market condition, the systemic risk, fiscal policy also is a factor. So there are a lot of things which are which are really interesting. Hence, what do we find? We find something very interesting. The software did a very simple thing that I can show you here. So in the next model, we will see that basically the software summed up the total amount. Okay, these are the Bank of England data for the STR, the 7-day liquidity facility. Okay, let me shrink it down. Okay, so every 7 days and every Thursday, banks tap into the Bank of England for a 7 days liquidity facility, and they can ask 60 million, they can ask 1.2 billion in aggregate, and we are at 92 billion. So if we sum up the amount that have been allocated week by week, we are at a total of 4.2 trillion pounds. Okay, so these are staggering numbers. Okay, so by Thursday of this week, the Bank of England expects to receive 92 billion of short-term liquidity that they have allocated. But if we sum up week by week all the money that the Bank of England has rolled over, we get to a total amount for the STR of 4.2 trillion pounds. So the liquidity that the Bank of England provides is not small change. It's more than the UK GDP. Okay, so that's why I have to repeat the same concept over and over again. The volatility in the bond market, in the UK bond market or the US Treasury market, for whatever it is, but mainly the UK bond market, is definitely not because of any newspaper headline. But here we are talking about 4.2 trillion, almost surely 4.3 trillion pounds of short-term liquidity. If we sum up week by week how much money the banks have been asking over and over again. Okay, so it's way more than the UK GDP. So it means that there must be some level of leverage into the system that creates all these requirement of short-term funding. And that means that there is leverage risk, there is systemic risk into the market, into the STR and the ILTR, there is liquidity premia, a discount factor as the haircut collateral constraining factors, the haircut component, so the market value is discounted, and so when volatility goes up, then we have all these amplifying risk factors, and there is the liquidity, the stress amplifies, and the cost of borrowing goes up, okay? And the total amount, it's 4,278,733,000,000. It's a huge amount. And the average, okay, if I do something very simple, no. Average, yeah, okay, if I take the average, numerical average of all the column, I should get to 26 billion or something. So it means that on average, the amount asked, the amount allocated across all this time is 26.7 billion pound, okay? And yeah, for the STR, for the data we have a total of 160 STR operations, the total amount summed up, which is not the real amount. The real amount now is 92. If we sum up all the liquidity provided, rolled over, we are at 4.2 trillion, right? Which is more than the UK GDP. And the average is 26.7 billion. The ILTR, so the 6 months liquidity window, we have 413 operations. The total amount up to now is 153 billion, almost 154 million. The average size, it has been of 373 million. And so, what do we see here is that we have some parameters, some volatility parameters which are related to the usage of the STR and the ILTR. And we can predict the volatility of the 10-year gilts with a machine learning model, which is random forest or gradient boost. The lasso ridge model, it's useless, totally useless. So these are they are really important methods to understand and predict the volatility of the gilts yield curve whenever there is ample usage, as we see, of the STR and the ILTR. And I promise we are almost done with everything. Let's see. I know what else we got here. So, always using the, no, it has jumped the page, I'm sorry. Bear with me 1 second. So here I have all the times that there has been volatility in, where it is? Oh dear. Okay, we saw this one, predicting the 10-year gilt volatility with a random forest machine learning model. We see here what is the total amount of STR provided. And here I pulled in also, I injected as data also the bank reserve balance sheet. Okay, so we see the behavior of the Bank of England. They do QE, they run it up to 978 billion, then they shrink the balance sheet to 640 billion, and by 2023, 2024, we see that the usage of the STR has increased a lot. We have reached the peak of 97 billion, now we are 92 billion, and with this data, then we run some models modeling what is the volatility because of QT, because of STR, and I found very interesting results, such as that here we have some identified high usage period of the STR. We see, for example, in 07, there was a 40 billion requirements, and in 08 there was 66 billion, and now in 2020, most recently in 2024, in September, we have 44 billion requirements for the STR. And as I found very interesting result for what concerns the gilt yields volatility according to the duration of the debt that the government perhaps needs to issue in order to raise money, and the usage of the STR. We have a lot of fancy charts, fancy parameters. So here, the average yield volatility by duration is pretty much the same as the chart above, but instead of having a 26-week moving average or a 15-week moving average, here we have the annualized volatility. And we can see here how between 2022 and 2023, with the mini budget or the pension fund crisis, because it was not because of the mini budget, okay? What happened, I explained 3 hours ago, is that funds, they were on the wrong side of the swap market. They were on the wrong side of the IRS swaps, the interest rate swaps, and on the wrong side on the inflation-linked swaps. So markets, they were probably they were working with variable rates, so they were paying variable, okay, or they were betting that inflation was steady, okay, steady inflation. Okay, so what happens when inflation goes up and interest rate go up, the value of the swap goes down. And if you are an hedge fund in the city and you use, because we have been talking about collateral, if you use gilts as collateral, and then what happens, that the value of gilts goes down, and that means you receive a call. Receive a call is Mr. Margin Call. Hedge fund, the hedge fund, which is not able to predict the market risk, ignores completely all macroeconomic variables, the hedge fund receives a call from Mr. Margin Call and says, all right, mate, you got these swaps with me, and you have this collateral, all the value of this stuff is gone down, you need to provide me more cash. It means you have to top up. You have to top up the value of the collateral. Value of collateral. And that creates what are all these dynamics, where in what I've been saying up to now for the past 2 or 3 hours, the usage of the STR, or the short-term repo, because when funds in the late 2022 and 2023, they found themselves, the pension fund, they found themselves in this situation. They were on the wrong side of their swap, and they leverage, because that's why it's LDI, because leverage driven investments, liabilities driven investments, sorry. So, but this L, we can use it for leverage, okay, because liability driven investment, it means that what they do, they take bonds, gilts, they use the STR, okay, they gather liquidity, and somehow to replicate the cost of borrowing and to gain some money, they use these interest rate swaps or inflation-linked swaps. They do all sorts of very complicated bets. But then when the value of the swap goes down, what happens is that they are losing on their position. And the clearing counterparty calls the hedge fund and says, okay, hello, this is Mr. Margin Call. You need to top up the value of your collateral. But to top up the value of your collateral, what happens is that they scramble to the STR. What that means that the cost, the yield, volatility spikes up a lot, becomes very, very spicy. Okay, that's what happened in 2022. It's not because of the mini budget. Okay, the mini budget was a side hustle, totally a side hustle, because they did all sorts of monstrous announcements. Like I'm not here to discuss fiscal policy. I'm just clarifying to demagogues and to commentators into the media. That's what happens. Okay, and if you don't believe me, just talk with somebody which is works at the Bank of England or whoever works in the city, and ask them what happened to their funds and what they had to do and why then you have this huge use now of the STR, because there was no liquidity in 2022, and now the Bank of England, subsequently, they are trying to stabilize the situation. Okay, and don't forget that the Bank of England gave a weekend of temporary liquidity facility to pledge any sort of collateral to solve this situation, this Mr. Margin Call problem. So back to our models, then we can use the QT variable, the STR variable, the IRTR variable to extrapolate to see what are the linear and the convex interaction with the yield curve. And we see here that we have a lot of volatility. And we see how our recent periods of volatility, they determine more than 60% in the term structure annualized vol. Okay, and we see here, for example, the rolling correlation, when it's positive or negative, it means they are positive or inversely correlated. So by the usage of the STR, we see the rolling correlation between short and long-term vol. okay, or short and long-term rates. Yeah, what else? What are the data here? These are again that's long-term yield volatility regime. We are in a phase between a high regime vol and hopefully shifting to a low regime volatility. Here we see where the September-October 2022 the dynamics of the liability-driven investment crisis period, all these hedge funds with exposure to the swap markets, and we see how in a short period of time then the yields went up a lot. Here we can examine what is the volatility term structure evolution, so how the volatility across the yield curve evolves because of period of crisis, and the most notable still is the LDI crisis. And what do we find? Okay, so in Broadbean's data, we see that for short-term yields, the recent average volatility is 63.94%. And the max vol, it's 8 times the average, 525%. So we are not talking about small numbers, okay? And for short-term yields, that means for all bonds which have a duration between 1 and 5 years, okay? So medium duration, medium-term yields, the average volatility is 64%, pretty much in line with short-term. And the maximum vol can expand to 8 times what is the average, recent average volatility. And what do we see? We have high vol days, okay, 930 days, 460 days, and the model tells us that we are 2 times the average. So there is a lot of days, a lot of times we have high volatility periods into the market. These are idiosyncratic factor of the yields market that perhaps the Bank of England has been trying to stabilize with the STR, the ILTR, but we see that the same usage of the STR, it generates long-term yield volatility. So that's why my study revolves around exactly these factors. So how short-term liquidity needs into the financial sector then are also a determinant factor of the bond market volatility. These are well-known concepts established since way before I have performed this. I have put myself into this mambo jumbo of days of work, but I managed to see what are the real parameters according to the most recent data that we have. And the long-term yields vol, they have a maximum vol that goes to 624%. It's humongous, okay? It's something around 10, the long-term yields, we are in the realm of, 15, 20 years, up to 50 years yields duration as a debt security. And you see here how the max vol, it goes almost 10 times what is the recent average volatility, which is not small. 60% volatility, it's high. And that explains why the 30-year yields, it's at 5.3%, because there is a lot of inbuilt volatility on average into the market. And in periods of distress, which are caused also by the STR usage, then this max vol can just explode. Okay, it goes higher and higher and higher. And the Chancellor of the Exchequer, it can't do anything. If we sum up the STR, we are at 4,278,733 billion. All right? So if we sum up all the money that the Bank of England has dished out week by week, it adds up to way more than the UK GDP. Although now the real amount, the effective amount, it's 92 billion for this week. God knows what will be the next week. And we see here basically all the in charts, all the interaction between the STR usage and long-term yields vol. Okay, so what happens? We have a very small, for this chart, we have a small correlation parameter. It's almost negligible, and because the STR it does not have. It's very simple to understand. For the STR, we have data from 2022 up to 2025. Okay, if I could have the STR data that start from 1990 or the year 2000, and they match exactly all the daily data of the yield curve, then for sure you will have way different results. But interpolating the recent data, we see here this overlapping chart is most significant. Okay, the STR here we don't have data. Okay, and here we have usage of the STR, which is 92 billion, and we see here how it propagates volatility in the borrowing cost. Okay, that's pretty much very easy to understand, and it's in percentage points, so volatility goes way above 100%. So the market becomes very, very volatile because there is requirements for collateral, there is liquidity premium, there is all sorts of things. So it happens that you have periods, days of very high volatility in the bond market. Okay, and here we have basically a demonstration of how the quantity, the reserve balance, is a factor for volatility in the gilts market, and the correlation parameter is positive 0.4, so it means that the levels of reserves at the balance sheet of the Bank of England explain 41.5% of volatility in the gilts market. And these are really important things or data to have, because they explain they explain all the mechanics of how important is the usage of the STR, the liquidity that the central banks provides to the financial sector in order to function. But on the other end, we have seen that the usage of the STR, we can see it here in this chart, the usage of the STR also is a factor of volatility, okay? Because there is pledging of collateral, which is sovereign debt, perhaps UK bonds, and that is a determinant factor with liquidity premium, the value of the haircut value, the spread that is applied for the ILTR auctions, and all that kind of stuff. Those determine the volatility in the cost of borrowing. Now, the days that we have today it's 19th, 18th, so what we see here, for example, that the 20th of November, Thursday, 92 billion of the STR expire, so we will see that 92 billion will have to flow towards the Bank of England, and then another auction will be made, and more liquidity will be issued. So we see that the market now it's calm, also because of inflation data, and the yield curve it's decreasing, its risk premium. But we see that the day after and in the following days, the market becomes more volatile because of the STR usage. Okay, so these are all things that explain everything about the UK, but not everything, but a very important feature about the functioning of the sterling monetary framework. So the bond market, what does the central bank, and these also have to be strongly considered by those who implement fiscal policy, because they need to know exactly when to place the auction, what sorts of debt they want to issue, the duration, and all sorts of things. So it's all important to manage the risk and to bring down the cost of borrowing and volatility in markets. So I truly hope that you enjoyed this video. It's a long video with a lot of content, so I thank you if you followed through all the content, and please subscribe, just leave a feedback, just put a comment, whatever, and thanks you so much, and I will see you into the next content.